Hello, everyone. Welcome back to the show. This is Dave Keller, your host, and I want to welcome on my guest, a good friend, a much more accomplished pilot than I will ever be, but someone that I've enjoyed talking with about those things very often. Tony Dwyer from Canaccord Genuity. Tony, thanks so much for coming on the show. I appreciate it very much.
Really a pleasure, Dave. Anytime.
So you had sent, we could spend hours on each one of these charts, some really good history and some thoughtful things. We started here looking at the S&P relative to Fed easing cycles, super timely. What are you seeing here?
So that blue line is the median gain of the mean gain of the S&P 500 when you look at prior easing cycles. When you look at the vertical dashed black line is the second rate cut, and the red line is the third rate cut. So typically you got your second rate cut about a month and a half ago, and typically you have a median 29 trading days between the second and third cuts. So this is fitting almost exactly with what goes on historically. And of course, the last two cycles, Dave, get all because they're the most obvious and the nastiest, they get all the attention. But if you actually look at it from the date of the second rate cut, which again was last month, your median gain 6 and 12 months later is 11 and 18% respectively. So the idea that the Fed is cutting rates should make you negative, I believe, is a lot more historically unique than it is. You should get bullish on it, and we are, as you know.
Right. So overall, I know you've been pretty positive on prospects for the market. This certainly seems to illustrate why that's an appropriate place to be. Now talk about this relative to the 10-year yield. I know this is a chart.
Okay.
Visually, a lot of people try to unpack. How are you describing this?
This is my favorite chart. Okay, so I got 60 charts. This is my favorite one. Here's why. We keep trying to make this thing like it's a unique relative to this cycle, and people say it's 10-year economic cycle, 10-year bull market, and I would disagree with that. So the question I pose to the viewers is, what if we're actually 9 months into a new economic and market cycle rather than 10 years into the same one? We've been through two prior mini recessions, and by mini recessions, I mean a manufacturing recession driven by global activity. So everybody knows that the industrial complex has turned negative, has been negative globally for some time. So everybody's looking for what's already been found. We have a manufacturing-based recession. The good news is money is still flowing, which we'll get to in a second. But the good news is that we've been able to not go into an overall major recession because the consumer gets to take advantage of lower rates. So let me take you through this slide. The red line is the 10-year note yield. The black line is the S&P 500. Think back to 2011 when the market made a 19.6% drop peak to trough. Now, I don't know about you, Dave, but that's 20% to me. So, I'm going to leave the media to the absolute 20% gain, but that's a bear market. What's interesting is that the S&P rallied 22% into that red line low, the 10-year note yield low. So there was about a 9-month lag between the drop in stocks, and then eventually the 10-year note yield reflected why? Weaker economic activity, and it made its low. Okay, during that period, the S&P was up 22%, obviously led by the defensive sectors because the yields were going down. Coming off of that low, the S&P off of that red line low, the 10-year note yield low, the S&P rallied 34% or 38% into the peak at the end of 2013 when the 10-year made its peak. So when the 10-year turns, it goes from a mini recession trade to an offensive trade. And the same thing happened in 2015-16. In 2015, we all know, was definitely an internal bear market at the low on February 11th. Then that led the low in the Treasury yields a few months later, again, reflecting what the stock market had already said, economic weakness. So the stock market went up 18% from its low in February to the low in the bond yields later that summer, similar to that other time. And again, once you made that low in the 10-year, you went offensive. The S&P went up 34% into the 2018 peak in yields. So again, I know I'm kind of grinding into this, but the current environment, we had the 19.8%. Sorry, Dave, I'm going to call it 20% again. Nutty, I know. The 19.8% drop in December of last year, that led the low in the Treasury yields in September. So again, this is the third mini recession of this cycle. So offense is the trade once you come off that 10-year note yield low, which we did.
So it's interesting. We're almost out of time, Tony, but I'd love to go back to this first chart and maybe think about the second one as well. I mean, with both of these, the challenge I've always had thinking about cycles and thinking about the repetitive nature of markets, how the markets tend to rhyme, is what if, and I mean, I hate to use a trite phrase, what if this is different, right? We're sort of seeing the median return, seeing the averages, but at what point would you see that something's different? Is it a divergence of some sort in the price pattern relative to what's expected? Is it a break of the cycle in something, or is it something outside of the chart of the S&P that you would be looking for? Like, what would be the signal that, okay, this is starting to be...
Can you go to the third slide and I'll show you?
You got it.
Okay, this is the corporate bond yields. You notice in 2007, 2008, 2009, how that bottom half of that chart was trending higher. Sure. It actually made its low in 2005.
Yep.
What happens when you're about to go into recession, which is the end of the game for the equity market, is when that top half, what drives that is the blue line, which is the high yield bond yield.
Right.
Starts going up in a risk-off trade, confirmed by a decline in the black line, which is the 10-year U.S. Treasuries.
Right.
So the spread between those two lines on the top half of that chart are shown on the bottom half. What you notice in the most recent activity is the yield on the corporate high yield index has gone down with the Treasury yields. That is so stimulative because it means that credit is still available and companies are able to borrow. So the first thing I'm looking for is when a true risk-off trade is happening, that blue line is moving higher.
3 or 2 fantastic charts and a really good take, Tony. Next time you come on, if you will come back on, we will spend the entire time talking about flying. But for today, I say thank you so much for these couple charts. Really appreciate it.
But it's always a pleasure to talk to you. Thanks, Dave.